So then I teach people how to make the mathematical simple formula for getting to $1 million of revenue and 10 million of revenue. Why those two levels? Because only 7% of entrepreneurs get there, and only 4% of those get to 10 million. And then I start teaching them what are the tools to scale from 10 million to 100 million and 100 million to $1 billion. How do you as an entrepreneur change your mindset and your gears at these different size points, and how should your behavior change?
Welcome back to the Home Service Expert. Today I got a good friend of mine. He's been on the podcast. This is his third time. Adam Coffey wrote the Private Equity Playbook, Exit Strategy, and his newest book is called Empire Builder. He's an expert in growth strategy, mergers and acquisitions, new business development and exits. His latest venture is CEO Advisory Guru, and he's the founding partner. He started that in October of 2021. Empire Builder, CEO, coach, in-demand speaker, and three-time #1 best-selling author, Adam Coffey builds high-performance cultures that drives transformation, exponential growth. A CEO for more than 2 decades, he led 3 private equity-backed service companies for 9 PE sponsors, completing 58 acquisitions and realizing billions of dollars in successful exits. Coffey is a founding partner of the CEO Advisory Guru, serving as a management consultant and independent director to PE portfolio companies, family offices, and elite executives. His specialties include growth strategy, mergers and acquisitions, new business development, and exits. A proud U.S. Army veteran, Coffey lives in Texas with his family. Adam, it's always a pleasure to have you on, brother.
Tommy, it is good to see you, brother. And congrats on all of the success that you've had since we were last together. It's good to be back. Hello to all your listeners out there.
I learned a lot from you. I will say every book that you write is straight to the point. It's no fluff, and it's amazing. I'm kind of disappointed in myself that I haven't read Empire Builder, but that's going to be cut straight to the top of my next read. So tell us a little bit about why you wrote a third book and what you've been up to lately.
Yeah, happy to. So like all my books, they usually start as a college lecture or, a seminar. Empire Builder actually started as a seminar. So I had 350 people from 27 countries. They came to Dallas for a couple of days, and I gave them Empire Builder live. And then when I was done with that, kind of perfecting the pitch and the material, I then stopped the seminar, picked up the proverbial pen, and started writing the book. And that led to Empire Builder, the book. And really, the catalyst behind this was, you're a guy who's beat the odds. I'm a guy who's beat the odds. It's like there's 33 million small businesses in the U.S. Only of those 33 million, only 7% ever get to $1 million in revenue. And only 4% of the 7% ever get to 10 million. In revenue, and only 40% are profitable, and 50% will fail in the first 5 years. And so it got me thinking about why the hell is it so difficult to be successful in business? And I wanted to think about my 35-year entrepreneurial journey that I have been on, and I wanted to write a book that would be kind of the roadmap to success for all these millions of small businesses that are out there, to try to help change those odds and stack the deck more in the favor of Joe, or Jill entrepreneur becoming successful and doing what you and I've done, building businesses, scaling businesses, exiting them for big numbers. And really, Tommy, to be honest with you, it's like I've made a ton of money in my career. I was bored being a CEO. I needed a different kind of challenge, and I wanted to give back. I wanted to impact as many people as I could. And I figure, if I can make PE firms billions, wouldn't it be fun if I could teach the common entrepreneur how to do buy and builds, how to, what the different levers of growth are, what are the activities that guarantee their success? And I thought, boy, wouldn't it be fun if I could spend the next 10 years, call it, of my life teaching other entrepreneurs how to be successful. And so the first book from that effort is Empire Builder. And I'm blessed. It's been doing really well. As always, I donate all my royalties to charity, and it helps fuel my philanthropic work. So it was never about money. It was about helping people succeed.
Yeah, that's fantastic. When I first read the Private Equity Playbook, I sent you a picture. I was on a plane.
I still have that. You were the first person to be on an airplane reading my book. Yes. That was one of my milestones as an author was I want to walk on a plane and see somebody reading my book. And I wasn't on that plane, but you made that dream come true. Yeah.
There's these nightmare stories. I'd say 9 out of 10 are nightmare stories of PE. I was very, very lucky. I love Cortec. They're great. They're very hands-on, which I needed. This is my first rodeo, if you will. Yeah. So they give me a lot of autonomy. They said, Tommy, if you feel deeply about anything, and they only get behind founder-based companies. And they said, if you got a really strong will to do something, we're not going to get in your way. They're trying to drive the acquisitions. They get behind that a little bit more. They evaluate that. But as far as organic growth and what we do within our four walls, they give me a lot of autonomy, and I appreciate that. And I got a call from them right around Christmas saying that this was their best in the company's history, at least for home service. I don't know about every investment they've made, but we had the best first year of any company. So I'm enjoying it and I'm learning a lot. And I will say that PE is not a bad thing. A lot of people think PE is a 4-letter word. They come, they disrupt, they change the industry, they ruin things. I'm just curious, what's your take? Because you've been around the PE world for a long time.
Yeah.
I really want to talk about the book at the different stages. And then I want to zoom into where I think most of our listeners are at.
Yeah. So, just to answer that first question, look, there's more than 6,000 PE firms out there. I think, last statistic I saw, we're pushing near 8,000 PE firms now. And, when I first started my career running companies for PE, there was less than 2,000. God, I think there was like around 1,400 and some odd. And there was less than $1 trillion in assets under management. Now there's $6 trillion in assets under management. When I wrote the PE playbook, it was under 3. And that was 4 or 5 years ago. It's like it has just continued to explode. And like any industry of size, there are good firms out there. There are bad firms out there. There are horrible firms out there. And so like any industry, there's a mixture. And I think, just the general entrepreneur, still to this day, Tommy, I really honestly believe does not have a good working understanding of what private equity is and how it works. The reason I know this is because every time I teach a seminar, or I give a lecture, and I start with a basic 10-question quiz, multiple choice on private equity, basic stuff, not trick questions, all the answers in my first book, and 90% of the room fails. And these are people who own businesses. They're millionaires. Some of them have businesses with 9-figure, revenues. And they still don't have a basic understanding of what is now the largest economic force on the planet that really drives entrepreneurial success and behaviors. We have PE now buys more than 50% of the companies on the planet. And it's because of PE that we're able to sell companies for high multiples and generate the kind of shareholder returns, for ourselves and for people that we work with, and it's because of that. During COVID, my sponsor was Ares Management at the time, one of the largest firms on the planet. They're the world's largest non-bank lender. And they helped me create a foundation, and they funded it out of their own pockets so that I could help. And they did this with every portfolio company they had. Any of our employees who were impacted, I had 3,000 employees at the time. Anybody who was impacted negatively by COVID, death in the family, they got sick, they had to miss work for an extended period of time, and they helped me create a foundation to take care of my employees. That's not the kind of news story you ever hear, about private equity, but it does exist. And so I wrote the first original book was because the private equity I heard about on TV and the private equity I would hear about, at the club when I'm having a drink at night with my buddies, very different than my own personal experience. And so that's why I wrote that first book. My experience with PE has been very different. Like you said, if you have the right partner, you get a lot of autonomy. Culture is important to you. It's important to them. It's important to their investors. And you can do two things simultaneously. You can create a great place for people to work, where they can have a career, and they can become wealthy, and you can generate the kind of returns that excite shareholders too. And you can do both of those things. And so, my experience with PE has been very different. And as you said, when you talk to people for the first time, it's hit or miss. I had a bad experience. I had a good experience. Generally, it's because we didn't know how to pick our partners.
I think when you're meeting with PE companies, I think there was about 90 companies that saw our opportunity, our SIP.
Yep.
And 42 made an offer.
Yeah.
And then 5 made it to the table. And it's tough, man. I'll tell you, they promise the world. They all sound very similar, right? They give you this is our average return. Here's how we treat. And they're whining and dining you. And it's the first thing I think somebody should do is fly out and see their top companies in your space, like home service, and meet with those owners and see what they're like. In my particular group, we meet once a month. We don't have a formal board meeting. It's a formal meeting, and there's 200 pages on a PowerPoint. But it's not like your typical chairman of the board who's on the board. Like, we technically have a board, but it's very loose.
Yeah.
And the one thing I'm hearing out there, I'm getting phone calls, probably less than you, but more than most, of all these guys calling me up saying they're going to do an HVAC roll up or a pest control roll up or a fencing roll up. And I said, and these guys are really smart. Like, they're number ninjas. They're financially more literate than most. And I say, well, what are you going to do for operations? How's your integrations going to work? How's it going to walk and talk the same? Like, what do you mean? I'm like, well, you got to run HR. You want to have a national call center. You want to have economies of scale. You want to have purchasing power. You want to make sure you've got one CFO running everything, so the reporting's similar, chart of accounts. And a lot of people think you can just buy companies. And if you grow EBITDA, but no one wants to buy just a bunch of companies with a lot of EBITDA if it doesn't walk, talk, or act the same. And I'm hearing a lot of that. And even the guys I talk to at Service Champions or Wrench Group, I know the CEOs both very well. They've had to pause their growth because they're not walking and talking and acting the same in each market.
Yeah.
And it's just one thing that I warn people. I had a guy send a podcast to me about garage doors, and this new company got in. And they said, we're not like PE. We let the owner do their own thing. We just support them. And I'm like, well, how do you do that? Like, it's great to buy great companies, get behind great CEOs. But if you're going to form kind of a conglomerate, there's got to be some type of symmetry. And I said, this sounds great and dandy. A lot of owners would say, sure, I'll take your investment. I'll keep running my way, but it never lasts.
Yeah. So some more interesting statistics. 73% of entrepreneurs who sell a business to private equity do not make it through the first 5-year hold period. That's a huge number of
70%.
73%.
73%
of CEOs or of founders, founder-led businesses, where entrepreneurs sell to PE, 73% don't make it through the first 5-year hold period. Why is that? Well, I mean, that statistic sounds daunting, but if you break it down, it's like, okay, so there is a percentage of people who are 70 years old and they plan to retire any damn way, right? So that's a percentage. And then you've got another percentage or a big group of people who's like, hey, I just got a wheelbarrow full of gold. I don't feel like working too hard anymore. And your new PE sponsor says, well, I gave you that big wheelbarrow full of gold because I expect one that's 4 times bigger when I go, and I need you to work harder than you've ever worked before in your life. And I'm going to be the capital behind you, but M&A, we're going to crank up. We're going to start, really busting on growth, making things happen. It's like, and some group of people just, I don't have the game anymore. I just won the championship. I don't want to go back to spring training and start over on a new season, and then you've got some people who just don't make the transition. But for those people like you who pick the right partner, who've got the right mindset and attitude, then working with a PE sponsor can be a glorious thing. And as I've said before, it's like, why sell a great company once when you can sell it twice? Or my personal record, selling the same company 5 times in 13 years and 4 months. It's like, I like selling companies, getting paydays. I like seeing my shareholders do well. And it enables me to be a good steward to kind of employees and build a great culture and help them develop their own careers. And so you just talked about buy and build. So let me riff on that for a minute. I think the single most popular tool in the toolbox of private equity that leads to the largest percentage of shareholder return is this thing called buy and build. So we buy a bunch of companies, we put them together. We do what you just mentioned. We create the operating leverage by integrating at some level the back office and all of these different functions, of the companies that we're buying, and we become more profitable. But a lot of people just assume if I buy a bunch of companies and then I take them out to market, I'm going to make a bunch of money, and it's not quite that simple. We have to have sound strategy. We have to pick the right type of partners, and so I profile. I tell you, I teach private equity firms how to do buy and build. At this stage of my career, and so many people get buy and build wrong because they fail in the beginning because they don't have a sound strategy. What are we trying to accomplish? What's the strategy that we're pursuing? What is the profile of what good looks like? And how do I stay disciplined? I call it shiny penny syndrome in my book. And when everybody just wants to do deals for the sake of doing deals, we overlook the warts, and all we see are shiny pennies. Every deal looks good. Every deal is going to add value. And, when you're doing a buy and build, my last empire was in HVAC. I bought 23 companies in 5 years. And the one before that, I bought 34 companies. And, it's like, you can't buy a bunch of fixer-uppers and have a bunch of cowboys that you can't put saddles on. It's like you got to partner with good people who build good companies with good reputations, and you're aligned because you're all rollover investors in the same company. And then you harness the power of all of those entrepreneurs, and you work on things like creating the operating leverage and in developing the synergies. And just because you're growing through inorganic growth, that doesn't maximize value. You also have to be growing strong organically. You have to be creating an improvement in margins because you're demonstrating that I'm not just buying stuff, I'm integrating things, and a bigger company is operating more efficiently than a smaller company. And when you do it all well and you put it together, huge returns to be made. But I see a lot of small entrepreneurs getting it wrong. They're either not doing enough diligence, they don't have sound strategy, they're not focused on what good really looks like. And so doing a buy and build can go south really quick. And it takes a lot of discipline. And if you apply a lot of discipline, then good things can happen. And sometimes you get lucky, and sometimes you don't when you're just shooting from the hip and buying anything. Hey, it's a garage door company, therefore it must be good. And I'll buy it because it's available. It's like, now I only want to buy good companies run by good people who will add, to my collective horsepower and talent pool. So I tell you that it's a really powerful tool, but like any other tool, if I have the world's best woodworking shop and I turn it over to a novice, the stuff that they crank out, first of all, they're probably going to get hurt, but the stuff that they crank out isn't going to look very good. We need to have experience. We need to know how to use the tools that we're going to employ when we're building an empire. And if we learn how to do that appropriately, we get great returns.
If you grow, I've done some math. If we grow 30% organically, 30% through acquisition, year compounded after year 3, we 4x'd the business.
Yep.
That's without really moving the percentage of EBITDA dramatically. That's just pure growth. And I'll tell you, I've learned, kind of got my ass handed to me this year. I've learned not all acquisitions are great. We don't do commercial very good. We're not big in new construction. And unfortunately, most companies out there that are sizable, they do a little bit of everything, but they don't really know where their profit centers are.
Yeah.
So it's, I'm sure a lot of industries are difficult, but for our industry in particular, I'm like, what do you guys focus on? They're like, well, we wholesale and we do new construction. Oh yeah. And we do retrofit. Yeah. Oh yeah. And we do 20% commercial. And I'm like, wait a minute. Those are all different AR. They're all different truck setups, different insurance, different purchasing, different tools, different pay structures. And, I think they got into it for the right reasons because they said, when you're small, you take on anything you can.
Sure. Looking for growth.
And
you nailed it, by the way, and that comes down to strategy. When I would do a buy and build, and I'd start with a buy and build, I'd start by creating the profile of my perfect acquisition. And so I'll give you an example in HVAC. My perfect acquisition had a certain size EBITDA margin or higher. It was a certain size revenue, certain size EBITDA. It had a founder who was between a specific age group, a founder who was going to become a rollover investor, going to become a part, of the business. Their financial profile, their customer mix, customer concentration was going to be below a certain level. Their verticals that they participated in, I'm looking for more services than I am project-based. I'm looking for more, if it is project-based, I'm looking for more remodel versus new construction, and it's like I would develop this very detailed profile. And there was like 40,000 companies in the US that call it, were the top of my funnel. And as we're filtering through all of these and applying our filters, we kind of came out with, here's 1,500 targets that meet our initial screens and filters. Now let's start, how are we going to do outreach, with those 1,500? It's like we probably had 100 deals, that were active at any time in some level of conversation, always looking for that perfect match. And then we were also very disciplined in terms of price. We pay 5 times, period. And I bought 23 companies and I paid 5 times. And even when I would come across a company that was really good, and that entrepreneur and everything fit my filters, but the entrepreneur says, I want 8 times. Sorry, I'm a disciplined buyer. I pay 5 times. Good luck to you. And I'm sure they probably went on and found a buyer at 8 times. But I bought 23 companies at 5 times, and then I sold the resultant company at 14 times. And so it's like my arbitrage, or the difference between
9x.
But yeah, I'm going to get 9 turns. And it's like, and so I don't chase every company. I only chase the companies that meet my criteria, that meet my filters. And I find, Tommy, when you do a really good job up front of screening and knowing what good looks like, then I'll call it your batting average. The best baseball player on the planet was Ty Cobb. He had the highest career batting average. It was like 344, and he had some years where he batted over 400. Well, if you bat 400 in M&A, 6 out of 10 deals are bad, you're sunk. You got to bat 900 plus. I'll call it, in 20 deals, you can afford 1 bad one, but you better get 19 good ones. And if you spend the time up front developing that criteria by which you're going to focus on what good looks like, and then you stick to it and you be very disciplined on the buy side, it makes the integration so much easier. It makes hitting your goals and objectives that much easier. And so, being disciplined on the buy side is probably the most important part of being effective at a buy and build.
I've learned that, and unfortunately,
we've all learned it the hard way, brother.
Well, listen, sourcing companies is not easy. Not when what I look at, and I probably take a different viewpoint than you do on this, at least for my industry. I look at, like, I'm buying a marketing source.
Yep.
And I just overlap my KPIs. I say, what's your average ticket? What's your conversion rate? What's your booking rate? What does it cost you to acquire a customer? I love companies that are spending 1 or 2% on marketing, that are slammed.
Yeah.
Because that's initially, we're really good. We could add a lot of fire to that. We could literally triple that company in a year. And we haven't had a lot of opportunities because we needed to be very, very, very selective and only buy in markets we want to be in, and get very granular with the markets.
But you're just touching on another really important part. I spent a lot of time with data analytics. And so I would do things like, here was a statistic for me. On average, after we'd buy a company in HVAC, it would grow by about 25% organically in the first 12 months. How is that possible? So we use data science. So we'd say, who are the logos that we serve? We were a commercial company, not residential, so it's a different market. But who are the logos that we service? Are those logos national? If we're going into new geography, which geographies that we could potentially go in has the most overlap of existing relationships with existing clients? And then we'd look the other way. Of the companies that we could potentially buy, what relationships do they have within their little local territory that we could then transfer back to the mothership and all the different markets that we had? And then we would have sales on day one, it's like, we know who to call. Hey, Target, we're now in this new region that we haven't been in before. And, you've got 58 stores in this new territory of ours. And if you're not happy with your service provider, we can take over those stores for you, or whatever the example is. And it's like, we set up this cross-sell capability, and, it resulted in just high organic growth, that resulted from M&A. And by applying data science to M&A, it's like, I don't want to go into markets that are declining. Tell me the markets that have tailwinds that, that people are expanding in my given industry. And it's like, so when you start using data science plus your filters and let that inform where you go next, and, and what targets you pursue, it's like you can actually optimize, a better outcome than what you started with.
I had Ken Haynes on with the Wrench Group, and he goes, they're doing billions of revenue, and I think around 6 billion or something. And he said, Tommy, I like to buy companies where I could leave the owner and kind of give them the autonomy they need. And I said, well, and it was interesting. And this is the way I remember the podcast. This was like 8 months ago or something. He said, well, we had to bring health care into the mothership and kind of put it across the board. And I said, what about call center? He said, well, we're probably going to be moving that internally more, where we'll train each and every person so we get economies of scale. And I said, well, what about purchasing? He said, well, we're probably going to have to move that in-house if we're going to get the discounts we want as a company. And I said, what about training? And he said, well, that's going to have to come in-house too. And you hear, it's a great concept. Buy a great company with great leadership, with great founders, and let them do their thing. Well, the problem is they don't get the economies of scale. They're buying from different vendors.
Yep.
It's like that.
So you're leaving money on the table, and they're a very successful company, but that also means that there are further opportunities for subsequent owners down the road to start integrating, call it the operational side of the business. And
right.
And so when they do that, there's more, call it, there will be an uplift in EBITDA margin and profitability. And so I think all those things are important. That's an important part of building an empire. And I've done it where I call integration light in some of my empires, and I've done it where it's integration full. And it kind of starts with, I need a scalable platform. So if the mothership can't take on all of those functions because we're dysfunctional in the mothership, I have to build that. And so I may go integration light to start. But somewhere over time, as this empire is building, I've got to put in place a scalable platform that allows us to fully integrate all the businesses that we're buying. And if I see differentials, that's where that cues me in to create a different division. And so you talked about just, you're finding these companies that, well, they've got, some commercial and some residential and some of this and some of that. And it's like, quickly you might find yourself saying, okay, well, I need to have a commercial division. And I need to have a residential division because they're different, and how they operate's different, and how they attract customers is different. So I need different leadership and different, call it KPIs and different focus areas. And so that's what usually led me to build multi-divisional companies. But I'm still going to have some level of integration. I might be integrating companies at the divisional level because what they do is different division to division. But then finances is integrated at the corporate level all across the board. And so you have to pick your level of integration that you can successfully do, but it'll make a difference in your profitability. And as the company gets bigger and you start talking about enterprise values in the billions, then the buyers at those levels, these are the things that they're looking for to maximize their potential. Is the company doing this? That'll have an impact on the valuation. It'll have an impact on the plan that they put in place, call it for their 5-year hold period.
Now, tell me this. This is a personal question. I was told that once a company reaches north of about 125 million of EBITDA, the buyer pool goes down dramatically into one or two handfuls, not a lot of companies, and the number I heard was 125 million. So once you go to like 150 million, you're probably going to get 3 or 4 turns less because it's not as competitive. Where you'll still have about 20 companies at the 125. When you start going north of that, smaller pool of companies, and although they're not supposed to talk, Blackstone, KKR, like somehow a little birdie kind of tells them where they need to be to get a deal. What are your thoughts on that?
It's interesting. I have a slide that I put up in seminars. It's actually in the book. I call it the PE pyramid. And, so imagine a pyramid, if you will, and then imagine that the pyramid itself, is capital. There's $6 trillion in capital that make up this pyramid. And so there's 6,000 PE firms up one side of the pyramid. And at the top of the pyramid, where it's the smallest, you've got KKR, Blackstone, Apollo, Carlyle. And their fund sizes are 10 to 30 billion in size. And then you got 6,000 firms down the side of the pyramid, and the smallest PE firms are at the bottom. And their funds may be, $80 million in size, $50 million in size, really small guys. And they're everywhere up and in between. Interestingly enough, they all do the same exact two things. Number one, they all invest 6 to 8% of their capital from a fund in any one company. They don't do more than that. They don't do more than about 12% because of asset diversification. They can't be overweighted in any one company in the fund. So it's they all invest 6 to 8%, which means if I'm Apollo or Carlyle and I've got a $15, $20 billion fund, 6 to 8% is a really big number. And I can't buy small companies. I've only got 10 years of fund life with which to buy stuff, improve it, and sell it. It would take me 100 years to put that much money to work if I bought small companies. And so the end result is big PE firms buy big companies, small PE firms buy small companies. And there are 5 swim lanes, I call them, of capital. You could have 5 hold periods if you were starting at 0 and work your way up the PE pyramid. And so buyers, the real world of PE starts at about 4 million of EBITDA. There are firms below that. They generally aren't what I would call a traditional PE firm. But at about 4 million, those people take it to about 15. 15 goes to 50, 50 goes to 100, 100 goes to 200, 200 goes to public. And as you're climbing up the PE pyramid, on the left side, I've got a tab, like a Velcro tab, and it is the what I call the valuation multiple for given sizes of companies. And so at the bottom, there's a lot of small companies, and so the multiples are lower. And as I'm getting bigger and climbing the PE pyramid, the multiples are going up because I'm becoming rarer. So let me give you 2 statistics. I told you already, there's 33 million small companies in the USA. Those are all in the bottom 2 rungs of the 5-level PE pyramid. At the top of the pyramid, there's only 3,000 companies on the planet that have $1 billion in revenue. 2,000 are publicly traded, 1,000 are private. And so as a company gets bigger, it becomes rarer. The reason companies do buy and builds and put companies together, I told you I'm buying, 23 small HVAC companies. I pay on average 5 times for each. By putting them together, I've climbed the pyramid. I sold it for 14 times. And so I've gotten the arbitrage because the bigger company is rarer. Bigger PE funds have fewer opportunities to buy companies. And so what they wind up doing is they wind up actually paying more for these companies because there's fewer opportunities to put money to work. And so I've built companies, that had, call it from 17 million of EBITDA to about 125. Once you get up to kind of the KKR, Apollo, Carlyle level, their real exit is public markets. There's not enough competitive tension to build a private company. You also then, from a capital perspective, you've got the companies are so big and the loan syndications are so big that staying private is virtually impossible. Even in the companies that I've built, when you're halfway up the pyramid, you've got syndicated loan structures or debt structures, and you got a bunch of banks that own your debt. They're publicly traded. So I got to go to the rating agencies and get my debt rated every year in order for those companies to trade my paper. So small companies, as they get bigger, become rare. They trade for higher multiples. Once you get to the top of the pyramid, there's not enough buyers to keep the competitive tension. And so their real exit potential is the public markets. And as you go up, they all also are modeling, call it a 3x multiple of invested capital as their base level of return. Smaller firms tend to get a little bit higher multiples, and bigger firms tend to get less when they're selling because, as you mentioned, there's not enough buyers. and there's a limit to how fast you can grow a giant company. So my specialty was always, call it middle market, the bottom of the pyramid up to about 2/3 up the pyramid. It's so if you're a CEO and you got 100 million of EBITDA and you got to get to 200 million of EBITDA, the amount of work that takes place to get a 3x multiple of invested capital is just exponentially harder than if you're a $17 million EBITDA company going to 40, and I can do that very quickly for the same 3x multiple of invested capital return. So I usually would take a company up through 2 or 3 flips of private equity, cycle back down, pick up another company, carry it up 2 or 3 flips, cycle back down. It's like that was the sweet spot of where the majority of wealth was easy to create, was kind of those companies that are first-time institutional capital going from 4 million of EBITDA to 15, 15 to 50, 50 to 100. Those 3 levels of the pyramid, that is where all of the what I would call the action is. Some people get hung up on, hey, I've got this big name on my business card, back when we used to carry business cards that everybody recognizes. I'm hung up on where can I make the most money the fastest, and how can I engineer that kind of an outcome and build a cool company that takes care of employees that everybody loves to work at. And that happens in the bottom 3 runs of the pyramid.
So why don't more PE companies, I know there's not a lot of them that know how to do an IPO. It's like most companies are like, we're not your company to do an IPO. It's like Cortec did it with Yeti. And it's not that they wouldn't do it again, but they're not very excited to do an IPO. What is it?
It's interesting because there's very little public company exit activity, and so first of all, you've got Sarbanes-Oxley and you've got all of these regulatory pressures. There's a complexity to going public, and so you've heard of SPACs as an example. And so
special Pacific, that kind of went away. It was hot for a few years.
Well, so let me just explain the whys behind this. So it takes over a year to go public. And in that year, a lot can happen. Pandemics happen, wars happen, interest rates can climb. And so there's always a lot of risk when you're going public. Will the markets hold? Will the values hold? Will the debt markets hold? Will the economy be strong? And will I get the best value, bang for my buck, when I finally get to the day where I ring the bell and I go public? And so people started taking money public rather than companies. That's what a SPAC was. And they'd say, hey, Mr. Mrs. Investor, I don't own anything. And therefore, it's very easy to take money public. And I don't have all this complexity of compliance issues. I'm taking money public. Once I go public and I've got a pool of capital because you bought my stock, now I'm going to buy something, and I'm already public now. And so I'm using my public funds to buy a private company. And so they would take the money public before they took the company public as a kinds of a means of accelerating the issue of going public. And so, why is it difficult? Why is it hard? There's just a ton of risk. There's a ton of risk going public. It takes so long. It adds millions of dollars of cost, to a company's structure. And so I think one of the problems that I do see is a lot of times companies go public too small. And for whatever reason, Wall Street would tell you, or books would tell you, you got to be at least 100 million in size. Boy, I tell people I want to be $1 billion in size before I go public. It's like I'm going to add millions of dollars of cost. I'm going to have a ton of complexity. If I'm too small, my stock will be very, very thinly traded. Analysts won't follow me, won't cover me, and so now all of a sudden I've got all the cost and complexity. And I don't have the liquidity that's provided by the active turning of my stock, daily. And it's like I get the worst of everything. So it's not that people don't want to go public. It's that through the laws, over the last few decades, the government's made it very difficult to go public in a timely fashion. And there's a lot of risk because of volatility in the economy. And so that's why there's not a lot of public activity. Matter of fact, there's the opposite. Big PE firms look for public companies to take private. and to eliminate all of that cost and all of that risk, and then go back to being private where they can be a little bit more maneuverable and fix something that's probably stalled or not working properly. And maybe even potentially take it, a big conglomerate, break it up into different divisions, different size companies, and then dump them back into the public markets as their exit. So it's a complexity thing.
So there's a Terminex went public, and they were trading at 30x, and they're really the only company I know of size and stature that have gone public. And I know they were buying companies for 3, 4, 5x revenue. And pest control, the way that it works is a little bit different. They still look at EBITDA, but there's not been a lot of use cases for public companies in the home service space that I know of. There's solar, and there's obviously alarm companies and whatnot. But what are your thoughts on that?
So I love home services for a number of reasons, but I love it smaller and lower down the pyramid. And it's when you've got heavy fragmentation, pick an industry, any industry, and there's 40, 50,000 small companies. And right now we're going through, in this time period in our history, the largest transfer of wealth in the history of mankind. You've got the baby boomers retiring. Yep. You've got this mass need to exit. Thousands of companies. Here's another scary statistic for you. 80% of companies that would like to sell never find a buyer. There are so many small companies. A lot of them are lifestyle, companies that if the entrepreneur goes away, so does the revenue, so does the customer base. And so it's like, I love it down there. And I think, that from a goal and objective perspective, once upon a time, my goal was the same as yours. I wanted to ring the bell. I wanted to build a company big enough, take it public, ring the bell. That was kind of like, it just seemed like that was like the right thing to do or to aspire to do. I never got to ring the bell, and it's a piece of unfinished business. And, I had an opportunity not too long ago to be a CEO in a company that was then going to ring the bell. And I'm like, I really pulled on my heartstrings. It's like, that was the one thing I wanted to do that I hadn't done. And I overcame that draw. And I was like, nah, screw it. I'm having fun. I like it better in the world of small business rolling up. And I think it just exponentially gets so much harder to continue as you get to 100 million, 150 million, 200 million of EBITDA. How do you find 30, 40% growth? I mean, it gets really, really difficult. Growth starts to slow down, and now you get into what I call maintenance mode. Now we're in annuity mode. We've got good cash flow, good earnings. And now we're talking about price to earnings ratio. We're a great public company, but kind of the magic in the wild, wild west era is now done. And you're a builder, Tommy. You're a guy like me who loves chaos. There's a chaos in putting stuff together and building it, and we love and we thrive in that chaos. When you get to a certain size, that growth trajectory goes away, and now it's maintenance mode, and it's time for somebody else to come in here and be bored, and talk about, it's like, I grew, earnings by 7% this year. It's like, well, I want to grow it by 30 or 40 or 50. And, I want to create, jobs by the thousands. And so at some point, I think as you get bigger and you climb the pyramid, it's just not as fun anymore for guys like us who like building things.
Yeah, I agree. I know what you're talking about. And I'm still right in the point that you love to get into. When you said you had discipline to only say 5x, and let's say there was somebody offering 8x, but your offer was a little bit different. You roll. What would you allow them to roll? You usually, I believe you always say 35% is the magic number. So you'd probably tell an owner 35%. What would be, for me as an owner, why would I sell to you if I'm going to get a larger amount up front? Like what would be your way of saying this is a better investment?
So what I usually I'm not competing with another buyer, because that was another thing. When I'm buying companies, there's 40,000 of them in my industry. There's so many of them. Even when there's a lot of PE activity, it's like a PE firm can't buy every company that's for sale. So most of my deals were what I would call proprietary. So they were either developed by us internally. They weren't a seller. majority of the companies that I bought, they were not a seller before they talked to me.
Right.
Yes, they were getting calls from PE. Yes, maybe they were somewhat interested, but they never really pursued it. It's like I was a proprietary deal. I developed it. Or, a buy-side advisor that's working for me brought it to me. Very few were processes. Some of them were, they may have had a broker or they may have had some kind of seller representation, but it wasn't a broad process. So these are smaller companies. I'll call it, my average size company was anywhere from 10 to $30 million in revenue. Call it $2-3 million in EBITDA, and I'm paying 5 times. And so, so what would I do? I usually would build a spreadsheet and I'd say, here's your current size, revenue and earnings. Roll tape forward at your current growth rate out 5 years. Now, what are you worth? What's your revenue? What's your earnings? And if you sell it, what would you get? Roll it out 5 more years. How big are you now? What are your earnings? What would you sell? What would you get? Now let's look at an alternative 10-year path. You sell to me today. And a new column now, new column going across or new row, say, okay, you sell to me, you take 70 cents home, you diversify your asset base, your net worth, you protect your family, you get some chips off the table, you're diversifying. You're going to have to pay taxes on, and now you're going to get growth returns. So let's not forget about that growth return. And now you roll 30% forward. Now you're a minority shareholder, and you're getting a piece of the arbitrage on the next 10 companies that I buy or 15 companies that I buy during this whole period. My last run, 5 years, 23 companies. And so you're getting a piece of the action on that arbitrage on all those companies I buy. Now I sell it, and I sell a much bigger company at a much higher multiple. You get a piece of that 9-turn arbitrage on every company I bought. And now you get another pile of gold. You take 70 cents home. Your second check was bigger than your first check. You roll 30 cents forward, and now we do it again. When I get to the end of that 10-year period, this person's got probably an initial purchase, an earnout, 1 flip, 2 flips. It's like they've gotten 4 paydays, over a 10-year period versus 1, if they just held it and kept doing what they're doing. Every time I built that spreadsheet using an entrepreneur's assumptions about what was going to happen to their business, every time I built that spreadsheet, they made more money by partnering with me and joining my band of merry brothers, who've sold their companies, as well, and joining our buy and build adventure. They always come out better by joining us rather than staying autonomous. So normally I would talk to them about asset diversification is number one. And I really believe this, Tommy. It's like I could talk to you about a company, early before the pandemic.
Yep. The movie theater company.
Yeah. Yes. It's like, brother, I can tell you that bad things can happen, and entrepreneurs never assume bad things could ever happen to their business. They'll always be the same size they are. Planes fly into building, economies falter, governments tell you to shut your damn doors. It's like bad things can happen. And so I wrote an article for Forbes, about when's the right time to sell. And I coined the rule of 130. You take your age as a 2-digit number, you add to it the percent of your net worth that's tied up in this illiquid thing known as your company. And if those two numbers combined equal more than 130, chances are it's time for you to sell at least a part of your business to get asset diversification. Because if something bad happens, you're probably too old to have a full recovery before, call it.
So let's just do this. I'm 40, and let's pretend. Okay, just pick an arbitrary number. So you times it by 2, so that'd be 80. And then so
you're 40 years old. Before you sold, how much of your net worth was tied up in the business?
80%.
Okay. 80 plus 40 equals 120. So I tell you, you're still okay. You're getting close. But once you get over 130, so if you were 50,
that's at 130. Yep.
What starts to happen, Tommy, is when we're young, we're aggressive. We make good business decisions. Maybe we're too aggressive sometimes, but we're aggressive. We're building our business. We get to a certain age and we're mindful that we've got a lot of money tied up in this company. and we start making bad business decisions. We start being conservative with our money. We're not investing like we should. We're not growing like we should, because we know our runway's coming to a slower end, it's somewhere. It's like, we don't want to mess with the magic that we built and screw it up. And so it's at that point where, first of all, if I bring in somebody else's capital, I get the asset diversification that I need, but I'm not done yet. I still roll forward as a minority investor. We were talking off camera about Jeff Bezos. The world's richest man only owns 10.9% of Amazon. And if he can be a minority shareholder, so can you. You don't need to own 90%.
When he got a divorce, is he still the richest man because he had to give?
No. Yeah, and Amazon stock fell a little bit recently, so I'm going back a little bit. I'm morphing history. I think he's the third richest man on the planet.
No, it's interesting because like Parker and Sons, 5 turns. And I love the concept of this. And I recently had an event about 1,000 people, and I said, who here stand up if you plan on selling your business within the next 5 years?
Yeah.
Could have been more than 30% of the people.
Yeah.
And then I said 10 years, and about half the people stood up. And I said, why? There's so much unknown.
Yeah.
Like, what are you going to do? Obviously, all of your money's tied up into this asset for the most part. You might own a couple houses.
Yeah.
You might own a couple cars with depreciating assets. You might have some in the stock market, maybe some bonds or whatnot. But ultimately, I tell everybody I would never get involved with a business that doesn't have a 5-year plan or less.
Yeah.
And 3 years is where I like to live.
Yeah, I got to tell you too. So I think you're touching on it as well. It's like most entrepreneurs see that exit as a one and done event. I'm going to sell my company right off into the sunset with a wheelbarrow full of gold. And I tell people, I see that first exit. It's the first rest stop on the wealth creation highway. It doesn't have to be the end of your journey. I would come in, and scoop up where you think it's time to leave and be done. And then I'm going to carry it forward, 3 or 4 more ownership periods and growing it exponentially. And I tell people, if I give you a wheelbarrow full of gold, the first thing you have to do is figure out what the hell to do with it. Why not keep invested in the company that get the diversification to protect your family against an uncertain economy, but roll over something significant that yields a large.
At what age would you say would be where you're not thinking much about rollover?
So I would say when you're young in your 20s, 30s, 40s, you're aggressive, you're still up. But as you get into your 40s and you're getting up into your higher 40s and into your 50s, it's like, normally that's where the rule of 130 is gonna add up over 130. It's like it's time to diversify assets. But I also think about it in terms of revenue size, Tommy. So if I've gotten a home service business to 4 million of EBITDA, and I can sell it for 8 times 32, call it 30 to 40 million. And if I can get to 10, 12 million of EBITDA, and I can sell that thing for now, call it 120 to 150 million. I want to lock in some of that profit. I think of it like a stop loss when I'm buying or investing in stock. It's like when you got an asset that's worth 150 million and you're only worth 7 million, 8 million outside of that asset, you're imbalanced, And so if I get to 30 years old and I got an asset that's worth 100 million plus, it's time to ring the bell. Ring the bell, put 70% in the bank. Roll.
So if you were 62.
Yep.
You're 59. If you were 62 and you had a $10 million EBITDA company, would you still roll 30%?
So as I get older, yes, so because it's typical 5-year hold period, right? So I'm going to get that money back. You pick your retirement time, because here's another trick I'll teach you. Never walk out the door as an entrepreneur. Let's say you're 2 bites in. You're my age. You're 60. You're coming up on the 3rd bite. Instead of leaving there, re-up, roll over, and then leave halfway through the hold period. You engineer that with your sponsor, your partner. Now I'm out of the business, but I still have money invested in it. And when they sell it next time, even though I'm not there, I'm going to get that last bite of the apple. And so that's where I'm at with CoolSys right now. I was the investor, I get the bite, I diversify. Now I'm out, but I still got a significant millions of dollars invested there. And I'm not there, but when that business sells, I'm going to get that last payday, call it. And so, I believe in multiple bites of the apple because I can diversify risk. I can invest elsewhere, and that gives me good, call it diversification of my net worth. But now I can still be aggressive in growing a business, and I'm using somebody else's checkbook to fuel the growth. And so I can be aggressive and I can still make, good sound business decisions. And I've got a partner to ride shotgun and help me with, but I'm using their capital and they've got the biggest checkbooks in the world. And so I can deploy an unlimited amount of capital. Really what we're talking about is debt relationships. We don't pay equity for companies. We leverage debt,
Right.
but they bring those relationships to the table. And so I can get much more aggressive now while I have the protection of asset diversification. So, I think of it in terms of size and or age. So if there was a second part to the rule of 130, it would be if I got an asset that's worth 100 million plus, I probably should ring the bell rather than take a risk of something bad happening to that company. Get the diversification and keep going. Don't walk away, keep going. When it's finally time to get off the merry-go-round, get off in the middle of the hold period, not at the end of a hold period. And then you get one last bite of the apple, even though you're no longer there.
So with Colsys, did you guys reevaluate the company share price every year?
Every time we bought somebody, usually it's about once a quarter, but they may formally do it once a year. But keep in mind, they've got limited partners. And so limited partners have made investments in a fund. The fund has to be able to report back to those limited investors, what the current value of that fund is, both realized assets and unrealized assets. That's a part of the game. Now, notoriously, PE firms undervalue companies during the hold period, which actually is a benefit to someone who's selling a company to a PE, firm.
Yeah, because their equity counts as a higher value.
Yeah, and so we don't want lawsuits if we're a PE firm. And so we're not aggressively overvaluing and then telling an entrepreneur, well, sorry, it wasn't worth as much as when you bought it. We tend to sandbag, during a hold period. And so we hold the valuations low, but we still have to have some semblance of what fair market value is because we got to report that to limited partners. And so people who roll over, classic example, the last company I bought before a sale was literally, it closed 2 weeks before I sold the bigger company. How much do you think they got in 2 weeks? Well, I'll tell you, they got 20+%. Not a bad return for a rollover for 2 weeks. So, they tend to sandbag, but the companies are revalued every time you buy a company, especially if there's rollover equity involved. We have to establish what is the value of the company in order to know what the value of that rollover stock is. And then we typically are doing it quarterly to report to limited partners. At the fund level, for if you're a PE firm, you gotta keep. I'm an LP in several PE firms, and so every quarter I get statements. Here's the current value of this fund and your investment. And so they have to be able to report that. It's a part of compliance.
Do you have a few more minutes?
I do, sure.
So right now, everybody's calling me. Cowen, every single broker, PE companies, like it's crazy because deal flow is really stagnant. It's like everybody's looking. And because month over month is down for a lot of companies, the economy's weird, interest rates are weird, inflation's weird. Most of the sizable companies are just like, we're not ready because we're not going to get the multiple we're shooting for.
Yeah.
And I mean, you go to buy a company in the last minute, sometimes they like during the hot part of the market, they'd add that you still use that EBITDA.
Yeah.
But now they're like, no, if it's not perfectly integrated, we're not counting it. And I know a lot of deals that kind of didn't go through in this last year. And where do you think, I mean, unemployment's, I think, at 3.2%. Inflation is at 3.2%. It's come down from 8%. We're going into an election year. Interest rates, the Fed said, is going to stay where it is or come down next year a few times. Where do you predict the market over the next year or two?
So all my friends on Wall Street, everybody that I talk to, whether they're wealth management people, PE people, Fed, people that I know, it's like everything the market says, Fed interest rates will probably come down around 0.5 point to a point in 2024, continue in 2025, barring something unforeseen. interest rates will normalize with a Fed funds rate of around 2.5%. So you're going to have downward pressure on interest rates over the next 2 years, barring something unforeseen, that happens. I do want to mention that there is one cardinal sin in the world of private equity that a firm and a fund just absolutely cannot violate. And that sin is do not put money to work. So if I've raised a fund, my limited partners have reserved capital, and they're going to send that capital when the capital calls come. So the PE firms buying companies are saying, send me money, limited partner. For the first 5 years of that fund's life, they're asking me to write checks as an investor. Then they're returning them to me in the later years of the fund. Here's the problem. I'm reserving that capital, waiting for them to buy something for me to send them the money. If they don't buy anything, I've lost the opportunity to invest that money elsewhere, like in the stock market, and get my 8% return over an extended 30-year period. I not only don't get my 8%, I get zero, or I get whatever the money market rate is, maybe 4 or 5% right now. But in the last few years, it was really, really low. And so if I'm a PE firm and I don't put your money to work as an investor, I'm pissed off. And when you say, I'm going to raise a new fund, Mr. Investor, please send me some more money for my new fund, I'm going to say, kiss my ass. You didn't put my old money to work. I lost out. I was looking for a double the stock market return. I'm looking for 16 to 20%. I couldn't get 8 in the market because you didn't put my money to work. It's like, I'm mad at you. So I'll tell you what happened early in 23. I call it a game of chicken took place. So I've got sellers who had inflated expectations of what multiples they should sell for. And I had buyers who were looking at the math and saying, with high interest rates, I can't lever as much debt. If I pay you what you think you're worth, I'm going to have a 75+% equity check.
Yep.
I don't have enough debt leverage. And so I'm going to play chicken and I'm not going to buy nothing. And so the whole PE world just kind of grinded to a halt for the first 6 months. But by the back half of the year, deal volume started to return somewhat. And at the end of the day, doesn't matter, brother, whether they got to write a 50% equity check or a 90% equity check, they got to put the money to work. So what ultimately happens is, I'll tell it that founders, you won the battle. Now, prices have come down some. The crazy terms have come down. So it's like we've kind of got back to a more normalized market. But the entrepreneurs who are sellers, they kind of won the deal, and so now the money's got to get put to work. And where it ultimately gets moderated is PE firms and their funds are rated by the year they make their first investment. They last for 10 years, but the first year they make an investment in a new fund, that's called the vintage year of the fund. And so we're going to compare all 2023 funds against each other, and they have the same 10-year economic cycle. And so if what really happens is PE firms who are investing at high multiples with high interest rates are going to have moderated lower returns. But since they're rated according to their vintage year, it's a level playing field. All people, all funds will have had the same circumstances. So think of it like wine. I could have one vinter, and in 2015, the grapes were great because the growing conditions were good. And then 2 years later, the same vinter is putting out a wine that's not as highly rated because the weather wasn't as good. So the weather is the economy. The vinter are the PE firms. And so, it's like it's all going to come out in a wash 10 years down the road from now. Everyone, it was the anomaly. It's what happened. It's the same thing that happened during the Great Recession in 08 or 09, or when planes flew into buildings, in 01, or when, a war breaks out somewhere. It's like eventually it all moderates. So my prediction for you and your listeners is that PE fund, deal flow will start returning. It's already started to return. I'm expecting at some point the money has to be put to work, can't violate the cardinal sin. Deals and prices are not as crazy as they used to be. That's a fact. And interest rates, the pressure is going to be negative. We'll normalize at about 2.5%. And so barring unforeseen circumstances, I'd say deal flow slowly gets better in 24. It improves even more in 25. And for those people who had a little bit of extra runway in time, yeah, they ride out the period waiting for lower interest rates so that people can lever more debt and they can sell for that extra half a turn or extra turn. But at some point, the fund runs out, the life spans up, the asset has to be sold. The money has to be put to work on the buy side. And so it will not stay a crappy market forever. If it does, there's going to be a whole lot of PE firms going out of business, not being able to raise their next fund.
Well, that's what I've heard recently was there's a lot of arms coming due in these unsophisticated PE companies where they're like literally going to lose everything. The debt is so high because it's 12, 13% that literally their arms coming due and they're going, we don't have the money to do this. We got 7 million of EBIT or whatever it might be, but they can't afford to keep it because the new interest rates are going to kill them.
And so, I tell all kinds of PE firms and call it smaller family offices. It's like, this is the time to build what I call as an opportunity fund, because there are certain assets that were over levered that don't have the same value. And there's going to be some fire sales. There's going to be some great value, the values available for those who have capital and are ready to put it to work.
I love that. Well, listen, I want to end with just a little bit more about the book, The Empire Builder. If I'm going to read that book, obviously it's for anybody and everybody in business.
Yep.
Every walk of life. Where do you think the best value, I guess I'll find out what rung I'm on the pyramid, where I'm at, and then the book will actually tell me the next level.
I'll tell you, if I look for just the basic lessons of the book, certain things, tenants, if I'm starting something from scratch, I want to focus on a service that provides, takes care of needs, not wants. Wants are discretionary. During a downturn in an economy, I can forgo spending on wants forever, but I can't stop spending on needs. So if my roof has got a hole in it and it's raining outside and the water's coming in on my head, no matter what the economy is doing, I got to fix my roof. It's a need.
Demand driven.
Yeah. And so needs, not wants. Then I think about recurrent revenue versus project based. In my perfect business, I'm looking for recurring revenue. You talked about pest control. I sign a contract. When I acquire a customer, I don't get a one and done project. I get an ongoing revenue stream that I'm hitting their credit card every month, first of the month, and I'm only chasing people whose credit cards have expired, and most people sign a pest control contract, they forget about it. It's like they come once a quarter, they bill me every month, so it's like focus on needs, not wants, focus on contracted recurrent revenue versus project-based if you can. If you're a project-based company, try to create a recurrent revenue stream. I'm an HVAC company and I sell preventative maintenance contracts. I'll come out once a year in the spring before the air conditioning season. I'll come out in the fall before winter. I'll tune up your system. You'll get a discount if there's anything broken or wrong. It's like I got to create recurrent revenue if I want to hold the maximum value. A lot of entrepreneurs, Tommy, talk to me about, hey, Adam, look, I'll figure out how to get profitable when I get bigger. And I need more stuff and I'll figure it out. And I'm like, nope. The perfect small business, the perfect business works small, and it's profitable small. So I teach entrepreneurs about what I call the 30-20-10 rule. I got to have at least 30% gross profit at the operating level. I need my SG&A to be below, 20%. I need a minimum of 10% net profit at the bottom. And if I don't have the company right, in passing the 30-20-10 rule, don't scale. Go back to if I'm low on gross profit, I got to work price. I got to work my operating cost. If I'm at 30% gross profit, but I'm under 10% net profit, my SG&A is too high. I got to work on my customer acquisition cost. I got to work on lowering my back office cost. Once I get it passing the 30-20-10 rule, now I'm scalable. And so then I teach people how to make the mathematical simple formula for getting to $1 million of revenue and 10 million of revenue. Why those two levels? Because only 7% of entrepreneurs get there and only 4% of those get to 10 million. And then I start teaching them what are the tools to scale from 10 million to 100 million and 100 million to $1 billion. And how do you as an entrepreneur change your mindset and your gears at these different size points? And how should your behavior change? Because the 58 companies that I bought, entrepreneurs were all around 20 to 30 million in size, and they kind of tapped out. It's like, I don't got any more bandwidth. The magic that got me successful only worked to about this size. Now I got no more bandwidth. I can't get any bigger. I'm stuck. And I got to teach them how to shift entrepreneurial gears and go from being the first chair player of every section of the orchestra to learning how to be a conductor. Instead of managing minutia, manage process, learn how to hire good people, learn how to articulate a vision, empower them, put the KPIs in place that will drive, the behavior. M&A starts becoming a tool. Now I've got my first 2 exit points are coming up as I roll through 30 million, of revenue at about a 15% margin. I'm at that 4 million magical mark where I could take my first exit if I want to, and I'd sell it for between 30 and 40 million. But if I keep on going, I get up to about 60, 70 million of revenue. Now I'm crossing the $10 million EBITDA threshold. Now I got something that's worth 100 to 150 million. And I'm telling entrepreneurs, take the first bite right there. Diversify asset, bring in PE. Now I teach you about M&A and how to really accelerate the growth from, call it that 60, 70 million in revenue up over the 100 million and on your way to $1 billion. And then what are the behaviors? I can build a $10 million business in one local market if I'm a service business. But if I'm going to go to 100 million, I need multiple markets, and so how do I do that? So I really try to put together in what is a 5-hour read, the basic DNA. This is the workbook. You're going to get to $1 billion, but let's focus on all these different stages and how your behaviors change. And if we can do that, then your odds of success are just exponentially higher as an entrepreneur.
These are the workbooks you told me to read. Back in the day. That's been years.
Yeah.
So I love the concept of it. It all makes sense. I think the listeners are going to love this because I love the 130 rule, the 30-20-10 rule. I love that when you roll, there's so many opportunities to roll. It's like, and I love building like a pivot table to just show them, because one thing I never thought about was the growth return and actually adding that on the money, the 70 cents you took out of each dollar.
Yeah.
And you add that up, that's got to be a line item on the Excel sheet.
Yep. And that plus the roll, plus the second bite being bigger than the first bite, it's like all of that in totality exceeds the value of staying alone, being your own, call it master of the universe at your growth rate. You're missing out on all that arbitrage from all the companies that are being bought, in that buy and build adventure. And that's kind of the formula that I use, Tommy, to convince entrepreneurs that it was actually in their best interest to sell and join me rather than stay independent.
I think that's phenomenal. I learned a lot on this podcast. I love when we do this. We need to do this.
I got to write more books, or we just got to get together once in a while. And
hey, I'd rather visit Dallas than anywhere in California, personally.
Well, I'm here, brother. I'm 15 minutes from DFW. Come visit me. I'll take you to dinner here at my country club.
I love that. You golf?
Not very well, but I live in one of the most exclusive golf clubs in Texas.
So if we want to get your book, where's the best place to go? Obviously, probably Amazon is.
Yeah, Amazon's the easiest. It's available in any format: Kindle, softcover, hardcover, Audible. Adam Coffey. You'll find all my books, and Empire Builder's the name. And again, I donate my royalties to charity. This was never about money for me. This was about helping you, the entrepreneur, be more successful. And that's it, brother.
So I'll let you close this out. Just we talked about a lot of stuff. I've got notes and notes and notes. It's crazy the stats you threw out there. Just crazy thinking about it. But maybe there's something we didn't hit on that I'll just let you take the floor and close us out.
Well, in life, there are dreamers and there are doers. There are people out there who think about building an empire. Maybe they're stuck in the Fortune 500 world. They're listening to your podcast and they're thinking, God, I'm so comfortable. Do I really want to start over? Do I really want to get, into something new? Maybe I'm a small business owner and I'm struggling. I'm struggling to make it. I don't understand unit level economics. We didn't get into that, but I talk about how to perfect a perfect small business. Recently, a billionaire asked me to come run a household name company that everybody in the country knows. And I thought about doing it because the exit's probably public. And, I ultimately turned it down. But, he was trying to fix world hunger. And I'm like, how do you fix a 6,000 truck service company? You don't. You fix one truck at a time. And if I can fix one truck roll, one service incident, and if I can get that working, I can replicate that across 6,000. I don't need to fix world hunger. I just need to fix one truck, one service call. That's how you attack this problem. And so I would tell people, don't be dreamers. Get off your duffs and be doers. The majority of wealth in this country is created through small business owners that build an empire and monetize it along the way. So you're never going to make yourself wealthy working for somebody else. Get out there, be an entrepreneur. I'm seeing a resurgence in just general entrepreneurism, in the country, which I think is great. And I'm trying to help people be successful. So be a doer, not a dreamer. You get knocked down, you get back up, you try again. And have faith. You can be successful. I've met a lot of billionaires in my life, and there's one thing, when I get in front of them, I think about is essentially I go, huh? It's like, really? There's nothing special there. There's no difference between Tommy, you and I, and a dude in a truck. And because we used to be the dudes in the truck. And so it's like in this country, still you can be a guy in a truck. You can build an empire. So get off your duffs and get out there and do it in 2024.
Yeah, how do you eat an elephant? One bite at a time. I agree. I think, Adam, I will say that what I tried to create here day one was that entrepreneurial spirit. Yeah. That they could come run their own business under our wing, and they could get equity in the company as a technician, as an installer. And hopefully that changes their life, because there's going to be a lot of turns, and the turns only become bigger. Yep. And that money becomes more. Every company gives 10 or 15% equity units, equity incentive, profit units, whatever you want to call them. So why not share that with the front line of the guys out there doing the hard work?
Absolutely. And, you mentioned like some of the big PE firms, KKR, Apollo, some of those. I think it was KKR recently. They started a model where they were giving equity to every employee in the company. So the equity pools were going to everybody. Yep. And it's like, boy, in today's generation, the hardest thing for us to do as employers is to find workers. And, they want to know what we believe, and they want to be a part of something. It doesn't have to be sexy. Garage doors, HVAC, that's not sexy. But they want to know what we believe, and they want to be a part of something special, and they want to have, call it participation. And so I think companies with strong cultures do really, really well in today's world. And if you're a great company, you're a magnet that attracts talent. You don't have to worry about finding people. People come looking for you. So
it's on my top thing this year is talent, to be able to find more talent. Adam, thank you so much for doing this, brother. I know we went over. This was amazing.
That's okay, Tommy. Anytime, brother. Happy, happy for your success. Glad to see you.
You too, buddy.
All right. Take care now.